QuickBooks Pro Desktop 2021 Loan Manager Amortization Table with the help of Excel. Let's get into it with Intuit. QuickBooks Pro Desktop 2021. Here we are on the desktop. We have our QuickBooks program to the left. We have our QB file, our QBW file we set up last time to the right. I'm going to open up the QBW file, which will then open up the program and the file within it by double-clicking on it. Here we are in our QuickBooks file. We currently have the Open Windows open. You can open the Open Windows by going to the View dropdown, selecting the Open Windows list. We're now thinking about setting up a loan and the amortization table within it with the help of the loan manager, and the banking dropdown, and that's in the Loan Manager. Now we first need a loan which we need to be managing. So meaning we need something on the financial statement. So let's open up the balance sheet first. Reports dropdown. Company and financial, take a look at the balance sheet standard. So I'm going to open up the balance sheet standard. I'm going to put in our loan for 2021. So I'm going to hit the customize reports up top for 01/01/21 to 12/31/21. And there is going to be our balance sheet. Obviously, we have no activity in it thus far. Let's say we took out a loan. We're going to just think about how much the loan was first. We're going to just say it's $60,000 loan. Then we'll think about the terms and the payments on it and how the loan manager can help with that with the use and help of Excel. So let's say we're going to record a $60,000 loan. We could do that a few different ways. Let's say it's going to increase our checking account. So I'm going to go into the register to record it by going to the lists drop-down, chart of accounts. We know we do not have a bank account yet. I'm going to add a bank account by go to the account drop-down or rise up. And I'm going to go to the new. And we want a bank account. The bank account. And it's going to be continue. I'm going to make this a checking account. This is our major checking account. Checking. Let's just call it checking. That's good. And then save and close, and I don't want to buy any checks or anything. And then I'm going to double click on the checking, and I'm just going to record our loan here as of 01/01/21. So it's just going to be at the beginning of the year, which is nice and convenient. We took the loan out right at the beginning of the 2021 deposit, $60,000 that we're going to be taking the loan for. And the payee, it's coming from the bank. We're taking it out. It's going to be a bank loan. We're going to say here that we're going to be paying back in monthly standardized payments. The other side then is going to go to a loan account. Now, if I hit the drop down on the accounts that were provided to us, all we have in the liabilities are the payroll liabilities. There's something we have to think about in terms of the loans now. When you reflect the loans in terms of like financial reporting, oftentimes they're grouped into one account. And then they're going to be loans, which will then be broken out between short-term and long-term. Those due within 12 months, those due within a year. But for internal accounting purposes, it's often useful to line up the loans in their individual accounts so that we can match the account balance to the loan documentation and match out the amortization table. It's also not useful typically for us to break out short-term and long-term for our internal purposes. So therefore, what I would recommend then is creating separate accounts for each loan, possibly sub-accounts of a loan payable account that you can then collapse for presentation purposes, keeping them in one account, not breaking out short-term and long-term, but only doing so periodically at the end of month or year when necessary, if necessary, for financial statement purposes. So that's the method that I would kind of recommend here. So what I'm going to do is I'm going to set up a new account. I'm going to say new account. And this is going to be a loan type of account. So I'm going to say it's a loan. I'll say other current liability account. And then I'm going to say this is a loan payable. Let's just call it loan number. And I'll give it account number behind it. So I might say it's a loan. I might put the institution on the loan in the name here. And then possibly even the last four digits of the loan number so that I can track the same loan number because it's quite common for people to have multiple loans from the same institution, and I want to basically break those loans out. I'm going to put it in the subcategory of another category, which is going to be loans or loan payable. So I'll set up a new account, and it's also going to be an other current liability, which will be loans payable. So I'm just going to call it loans payable. And then I'll say save and close. So now this one's going to be a subsidiary of that parent account. I'm going to say save and close. And there we have it. Let's go ahead and enter this. And okay. If I take a look at the lists and chart of accounts now, we now have our loan and our sub loan down below underneath it. If I go to my balance sheet, then we have our loan on the books and the loan underneath it. For presentation purposes, I can collapse this and just show one line item, loan payable, without our account number, the loan account number in it and whatnot. Now that we have the loan on the books, then you want to think about, okay, what's going to happen when we make payments on the loan? Because if it's a standard installment loan, I'm going to make monthly payments that are all the same, but the breakout between interest and principal will differ. My objective then is to make it as easy as possible for the data input, even though the balance between the interest and interest expense and principal will differ. So how can we do that? Well, we can do that with the loan manager, which helps us set up the amortization table and also helps us to then make payments based on it, which can help the process going forward so that whoever's doing the data input doesn't have to basically look back to an amortization table. To get an idea of it, however, I think it's useful to create the amortization table in Excel. So we'll create it in Excel, and then next time we'll go in here and we'll create it in the QuickBooks system and see how they kind of match up. So traditionally, I would set up an amortization table in Excel, or in other words, if one, you get an amortization table from the bank, you can use that, of course, but they often do not provide the amortization table. You can ask your accounting firm to set you up with an amortization table, or you can make one, or you can do it in QuickBooks and kind of be dependent on the QuickBooks. I like to do it this way because it gives me a little bit more assurance that I've done it correctly. So we're going to build this amortization table. I'm going to do it fairly quickly because I know this is not a QuickBook or an Excel course, but let's do this fairly quickly. I'm going to add a new section here, and typically what we need is this first information. So this is typically what's going to be given from the bank. So we're typically given basically this information. I'm going to hold down Control and hit the scroll. I'm just zooming in. You can also hit the plus button over here to zoom in. I'm going to widen the column for column A a bit so I can see everything in column A. I'm going to widen out column B. I'm going to start to adjust the formatting of the Excel sheet. I'm going to adjust the entire worksheet first by hitting the triangle up top. That highlights the entire sheet, right-clicking on the sheet, and then I'm going to go to format the cells, format the highlighted cells, which is all of them. And then I would like to go to the account. I'd go to currency typically without a symbol on it. I'll make the negative numbers red and bracketed, and I do want the decimals in place. So then I'm going to say, okay, that's what we have. Now, typically I'm going to call this, loan 1, the name of the loan. The loan amount is $60,000. Now here we may not want the decimals. Maybe I'll just remove the decimals on this one because I don't need them there. And then the months are going to be 60 months. That means it's a 5-year loan. 5 times 12 is 60. So 5 times 12, 60 months, we're going to say. Going to remove the decimals here. Don't need the decimals there. The interest rate, we're going to say it's 5%. So I'm going to give the 5% here, and I'm going to make that a percent. Home tab numbers, 5% or 0.05. And then the payment's going to be 1132.27 about. Now this payment we calculated within the system. This information should be given to you by the bank, although they could basically remove any one of these information points, and technically they haven't you can still figure it out because you can still figure it out. Then they could remove one of them if they're being kind of sneaky. So let's kind of figure out how we get to this amount or back into like the interest payment, for example. The payment amount here, you can calculate. I'm going to delete this, and you could say, what if I needed to recalculate that? I'm going to just do it with a formula. You can also use the formula box, but it's called PMT, payment. So I'm going to type in equals PMT, double click the payment item here. And then what you need is the rate. You get this little helper box down below. The rate is 5%, we're going to say. That's the yearly rate. So notice what we're going to do is pay monthly. So I want to break that rate down to a monthly rate, which means I'm going to take that 5% and divide it by 12. That's the trickiest piece of this. And then I've finished with this first part. I want to go to the next part. So I'm going to put a comma. That's going to be the differentiation. The number of periods involved. The number of periods is 5 years, but we're paying monthly. Therefore, we got to match the periods to the percent. We now have the monthly percent. We're going to have the number of months now, 60. 60 months, 60 periods. And then we're finished with this item. I'm going to say comma to go to the next one. The present value, which is the current value of the loan, the amount we got, which was 60,000. And there it is. We don't need the future value or the type. We can close it up, or we don't even need to. We can just say enter, and it gives us our value. I like to see the value in a positive number. So what I typically do is double click on it and then put a negative before the entire thing, which will multiply it times -1, in essence, flipping the sign. So I'm going to put a negative. There we have it. Now this is rounded possibly because if I add some decimals, it's basically rounded, right? So we're rounding it to pennies. Now note that it's possible then that they're probably going to give you, the loan document will give you this information most likely, but what we don't have is the breakout between interest and principal per payment, because by fixing the payment here, we have varied the amount that's going to be broken out between interest and principal. So we'll have to deal with that. Also, it's possible they don't give you the 5% maybe, right? Because they could leave that out and just say, hey, you got to pay this amount over 60 periods, 60 months. So if they did that, you can use kind of the same formula to basically back into the 5% and see what your interest rate was. For example, if I know that this amount is, let's copy this. I'm going to copy this and I'm going to paste just the amount here. I'm going to say paste it 1, 2, 3, just the amount. So it's the amount. Now what I'm going to do is say, let's pretend I don't know what this rate is. I'm just going to make it like 1. Like let's just put an amount there. And I know my payment amount is this. So I have the same formula and I just plugged in a random rate for my same formula. Then you could use the goal seek function. I'm going to put my cursor off the cell. This is just a useful thing in Excel to note. You can use goal seek to kind of figure this out, which would mean you'd go to the data tab. You're going to go to the forecast, what if analysis. We want to go to goal seek, and you get this little dialog box, and we're going to say, I want you to set this cell to be, I'm going to hard code this number. It needs to be 1132.27 because that's the amount of payments that we're going to be making. They gave us that. They didn't give us the rate, the percent. So we just put a holding spot of 1%. And then we want you to change this cell to whatever it needs to be. Change this cell to whatever it needs to be to make this cell equal the 1132.27 and okay. And then it changes it to the 5%. So that's one way you can use the same formula to kind of back into any unknown, right? Any unknown within this item, you can use this formula to back into it and use the goal seek to do so. Okay, so I'm just going to delete this and bring this back to just straight 5%. And then we're going to set our amortization table up. Now, our amortization table will typically start with these headings. So I'm going to copy these headings. And I'm going to put that there. I'm going to say paste. I'll paste them 1, 2, 3, and then we'll format it. I'm going to format the entire worksheet to make it bold by going to the Home tab and then the font and make the whole thing bold. Then I'll typically highlight these. These are the headers. So I'm going to go to the Home tab, alignment, make it centered. And I like to make it like black over here in the font group and then white so that it stands out as the header. So then we're going to put the items below it. We have the period, number of periods, 60 of them. The payment, which is always going to be this amount. And then the tricky part, the breakout of the interest and the loan reduction, or sometimes called principal, right? Principal, loan reduction amount, the amount applied to the reduction of the loan versus the amount applied to interest, which is like the rent on the use of the loan. And then we have the remaining loan balance after we have the loan reduction. So once we have that, I'm going to set up the periods. Now it's useful to start with period 0, which is where we got the loan, and then start with 1 and then go to 1. And then I'm going to highlight those two, and I'm going to use the fill handle to drag this down to 60 periods. You get this little number right next to it that will show you how many periods you have thus far. So we want to bring it all the way down to 60 periods. So there we have it. And then I like to remove the decimals here so we can format this. I'm going to get rid of the decimals on the periods, and then I'm going to center it, Home tab, and center. So we'll center that. Now we're going to have the payment, or let's go to the loan balance on the right. At period 0, we have the loan balance of 60. There's the loan balance. Then we're going to have the payment. The payment will always be the same. Payment's going to be equal to the 1132.27. The interest amount then is going to be calculated as the 60,000. Let's do this with a calculator first so we can get an idea of what's happening here. How do we calculate the interest on the first payment? It's going to be the 60,000 times 5%, 0.05, but that would be for a year, and we only want a month. So I can take that and divide by 12, and we should get the 250. Or we could do it this way. We could say, well, the interest for a year is 0.05. We want the monthly rate. I'm going to take that and divide it by 12, which gives us a very small number, which is why we don't typically use the monthly rate, but the yearly rate typically, right, as a default. And then I'm going to take that and multiply times the 60,000, and there's the 250. So let's do that in Excel with a formula. I'm going to say this equals the 60 balance, loan balance in the prior period, times, we got times the 5%, and then that would be for a year. Now I'm going to divide that by 12. Divided by 12, and there's the 250. The loan reduction then, the reduction in the loan will then be equal to the amount that we pay minus the 250, and that's going to be the loan reduction. So then the loan balance is going to go down by the loan reduction. This equals the 60,000 minus the loan balance reduction. Now, if I was to do this with like a journal entry, or how are we going to enter the first payment into QuickBooks, we would say, okay, I know cash is going to go down. Cash goes down. I'm going to put the credit to cash by one. Let's do it this way. Cash would go down by this, and then we'd have interest expense, which would be equal to the 250, the rent on the loan. And then we'd have the loan balance. The loan itself would be going down by the 88220. That would be a reduction here. Debits equal the credits in that format of it, because this equals 0. So that would be the first kind of journal entry you would have for payment 1. What about the second payment? Second payment, the payment amount would be the same. It would be equal to the same amount, but the interest would now differ. Interest now would be equal to this 59,117.37 about times the 5%. That would be if it was for a year, but it's only for a month, so we divide that by 12. Now we have a slightly different interest amount, even though the payment is the same. So this is now going to equal this amount minus the interest. So now for month 2, if we were to record the transaction, the amount of cash would still be decreasing by this amount, but now the interest would be this, and the loan reduction would be that, resulting in a loan balance that would be remaining of this minus that. And so that would be the loan balance. Now, the fact that this changes every time we make a payment makes it difficult for us to enter it into the system and just allow someone to just record the same thing each time. It's the same accounts, but the breakout between these two accounts will differ. And that's where the loan manager can help, because if you can input this amortization table into the system, you can set up a system where someone doesn't have to think too much. You don't even have to go back to this amortization table. It'll be built into QuickBooks, so they can just create the check or bill easily, and it should make this breakout correctly. So let's just keep doing this all the way down. I'll do it one more time, and then we'll use the autofill. So once again, payment, same. Interest is going to be equal to this new balance times the 5%, divided by 12. Then the loan reduction is going to be equal to the payment minus the interest, and the loan balance will equal the prior balance minus the loan reduction. Now, if I copy and paste this down, I'm going to have a problem. I'll show you the problem. If I select these and I copy it down, there's an issue. What happened? This one does what we think it should, because it's the same number. It's just bringing the last one down. This one's going to have a problem because it brought the 5% down, and that's going to be the issue. So that's what I need to change. So I'm going to say undo that, undo this, and then I'm going to double click on this one, that 5%. I do not want it to bring it down when I copy it down. Therefore, I'm going to make cell B4, this B4 absolute, by hitting F4, being inside it, and hitting F4, or putting a $sign before the B, $sign before the 4. Then enter. Now if I copy it down, I'm just going to select it and copy it down one time. See if it does what we expect. This one does. This one looks about right this time. This one does what we would expect. This one does what we would expect. So now let's go ahead and copy that all the way down. When we do so, this balance should then be 0 after 60 payments. If it's not, we have a problem somewhere that we can go back and look at. So I'm going to select all of them, do the autofill handle, drag it all the way down to our 60 payments down below. So I'm going to drag it all the way down. And there we have it. It's down to 0. So the last payment here of the same amount only has 4.7 interest in it. and the rest of it is all principal because the loan balance was very small at the end of the loan. So now I'm going to select the whole thing and put some box around it like this. So I'm going to select this whole thing and put a box around it. So this would be an amortization table, which again, you might get from the bank. You can ask your CPA firm to build this for you or something like that, or your tax firm, or you can build it yourself. But then you still have to refer back to it every time you make a payment. Every time I make a payment, I would have to then go back and say, okay, now I want to pay the check. I would then have to say, okay, I'm going to write a check, and then I'm going to make the check be decreased for the amount of the 1132.27, 1132.27. That's pretty straightforward. And then I have the interest amount, interest expense, but that would be for this time the 250. So that would be for the 250, 250, and then the loan would be going down for the difference. Then the loan would be going down for the difference, and we want this one to be that. Okay. So then I'd have to record that, but then the second time I record this amount would be the same, but then I'd be on payment 2, so the breakout between interest and the loan would differ. Now that's not too bad. I can go back and forth and pick that up from the amortization table, but again, I might want to do this with like bank feeds. And if I have the bank feeds, then it's going to see this amount, but I won't be able to memorize these two amounts down below. And if I want to delegate this to somebody else, then they're going to have to always go back to the amortization table, and they may forget to do it because these amounts will probably populate based on the last check. So they may not update it all the time. So instead of me writing the check like this, maybe I then use the loan manager here, and I'll set up the amortization table here. And then once I do it, the amortization table should match what we made on this side. And then I can create the bill or check from the amortization table, and then basically just match it or check it off to whatever clears on the bank feeds or when I reconcile to the bank, and therefore it should automatically pull the right numbers, and we won't have to go back and forth to the amortization table manually when we do the data input. We'll just go to this area, put in the bill, put in the check, then match it to the bank reconciliation or to the bank feeds when applicable. So we'll start to input this one into the loan manager next time and see if we can replicate the same payment information for each payment type as we have here. Now, one other thing you might do is you might want not the periods on the right, you might want the dates. So you might say this is on 01/01/21, or let's say I make this a date field and hit the drop down, and I want the short date. So I'm going to say this is 01/01, and then I'm going to say 21, and this is going to be 01/31/21. This will be 02/28/21, and then you might be able to copy that down. So it's not seeing it yet. So this is going to be 03. Let's do this again. This is going to be 01/02/28/21, 03/31/21. See if it sees that pattern. Okay, so there we go. Now I can copy this down. So you might want to do that, and so then you'd have the dates. Hopefully that picked it up correctly. And then you might want the number as well. So you might want another. I'd actually have another column to insert. I'm gonna insert another column for the payment number. Payment number. I'll call it payment number. And then I format painted this home tab, clipboard, format paint, and then I'm just gonna say 1, 2. I'm gonna select those two items. I'm gonna go to the removing the decimals. I'm gonna center it. And then I'll autofill this down as well. So now we have both the date and the payment number, which could both be useful. So we'll have that. I'm going to add the grid lines around it. And so there we have that. And then this data up top, I might want to move it over. So I'm going to select the entire thing, Control X or cut, right click and cut. And then I'm going to paste it on A1. So there we have everything lined up there. So let's open this up a bit. We can close this up a bit. Okay, so there's our amortization table. We'll try to recreate the amortization table in the loan manager actually within QuickBooks next time.